This video is going to make some people uncomfortable. Not because it is alarmist or designed to frighten anyone, but because the data that underpins it is real, it is recent, it comes from credible sources, and it describes a situation that is already unfolding across British households right now. The baby boomer generation in the UK, the people born between 1946 and the early 1960s, is often described as the wealthiest generation in British history. And in aggregate, that is true. They own more property, hold more pension wealth, and control more of the nation's financial assets than any generation before or since. But the aggregate hides a picture that is deeply uneven, and even for those whose individual financial position looks solid on paper, there are forces at work that most people in this generation are not fully accounting for. Today we are going to talk honestly about why a significant proportion of British baby boomers are on course to run out of money before they die, what the specific mechanisms are, and what can still be done about it if you are in this generation or if you have parents who are. Let us start with the headline number, because it is more alarming than most people in this age group realize. Only half of UK baby boomers are financially equipped for retirement, according to Vanguard's Comprehensive Retirement Outlook study. The remainder are expected to fall short of the pension savings they need to sustain their current lifestyle in retirement or achieve a moderate standard of living. Half. Not a fringe minority. Not the people who made catastrophically bad decisions. Half of an entire generation. Only 51% of Britain's baby boomer generation have adequate financial preparations for their retirement years. Those fortunate enough to possess defined benefit pension arrangements show markedly superior preparation, with 69% meeting their retirement targets. This contrasts sharply with individuals lacking such schemes, where only 28% have achieved sufficient financial security. 28%. Less than 1 in 3 of the baby boomers who do not have a defined benefit pension have sufficient savings to meet their retirement goals. That is the financial reality for a very large number of people in this generation. And the gap between where they are and where they need to be is not a small one that can be closed with minor adjustments. For many, it is a structural shortfall that will express itself not as a sudden crisis, but as a slow, grinding erosion of spending power over the 15 to 25 years that the typical British retirement now lasts. Now let us understand why this has happened. Because the causes are not random, and they are not all the result of poor individual decisions. Some of them are systemic. Some of them are the product of a world that changed faster than the planning assumptions that most people in this generation made in their 40s and 50s. The first reason is longevity. The average life expectancy in the UK for someone reaching 65 today is approximately 83 for men and 85 for women, and those are averages across the full population, including people in poor health. A healthy 65-year-old British man today has a reasonable expectation of living into his mid to late 80s and a significant probability of reaching 90. A healthy British woman at 65 has a reasonable expectation of living into her late 80s or early 90s. That means a retirement that could last 20 to 30 years. And almost nobody planned for that. The planning assumptions that shaped savings behavior for most baby boomers in their working lives were based on retirement lasting 15 years if you were lucky. The generation before them typically retired at 65 and died at 70 or 72. Saving enough for 15 years of retirement on a moderate income felt manageable. Saving enough for 25 years of retirement on an income that rises with inflation every year is an entirely different mathematical challenge. The pension pot that looked comfortably sufficient for a 15-year retirement can be desperately inadequate for a 25-year one. And the gap between what was planned for and what life will actually deliver is the central source of financial risk for this generation. The second reason is the shift from defined benefit to defined contribution pensions. Government statistics indicate that 65% of individuals in their 60s hold pension assets within defined benefit programs, whilst merely 25% possess defined contribution savings. The baby boomers who have a defined benefit pension, a final salary scheme from a company or from the public sector, are in a fundamentally different and much stronger financial position than those who do not. A defined benefit pension pays a guaranteed income for life, adjusted each year for inflation, regardless of how long you live and regardless of what markets do. It transfers the longevity risk, the investment risk, and the inflation risk entirely to the scheme, not to you. If you live to 92, you receive your defined benefit pension income every month at 92, just as you did at 67. The defined benefit pensioner cannot run out of money in the pension itself, because the pension continues for as long as they live. But the baby boomers who do not have a defined benefit pension, the growing proportion who accumulated a defined contribution pot through auto-enrollment or personal pensions, face an entirely different situation. They have a pot of money. They are drawing from it. They are responsible for making it last for however long their retirement turns out to be. And if they draw too much, or if markets perform poorly in the early years of their retirement, or if inflation runs hotter than expected for a sustained period, that pot can be depleted years before the person drawing from it has any intention of dying. The third reason is the sequence of returns risk, and this is the one that most people in drawdown do not fully understand until it is too late. When you are still working and saving, the sequence of market returns does not matter very much. A bad year early in your savings journey is followed by more years of contributions that benefit from lower prices, and over a long accumulation period, the timing of individual years averages out. But once you are in drawdown, the sequence matters enormously. If markets fall sharply in the first 3 to 5 years of your retirement, and you are drawing a fixed income from your pot every month during that period, you are selling units at depressed prices. You are locking in losses. And the compound effect of those early losses on a depleting pot is devastating and mathematically different from the impact of the same losses occurring later in retirement. A portfolio that experiences a 30% decline in year 2 of retirement and then recovers over the following decade will leave a retiree in dramatically worse shape than the identical portfolio that had the same 30% decline in year 15 of retirement, even though the total return over the full period is the same. Early losses in drawdown are disproportionately damaging because they reduce the base from which future growth compounds, and they force the retiree to sell more units to generate the same income. This risk is real. It is well documented in retirement planning research, and it is inadequately understood by the majority of British baby boomers in drawdown right now. The fourth reason is inflation. As prices continue to climb and new global tariffs drive up costs, the financial pressure on Britain's baby boomers is intensifying. More than 90% of people aged 65 and over are now relying on their savings to cover everyday living expenses. Nearly 1 in 4 are dipping into those savings every month just to stay afloat. Inflation is the enemy of the retiree in a way that it is not the enemy of the working person. A working person whose salary does not keep pace with inflation loses real purchasing power, but their labor is still producing income. A retiree whose fixed income does not keep pace with inflation is simply getting poorer in real terms, month by month, with no mechanism to earn their way back. The state pension is protected by the triple lock, which has done an admirable job of maintaining its real value in recent years. But private pension income in drawdown is not automatically protected. If you are drawing 5% per year from a pot that is growing at 4% and inflation is running at 3%, Your real withdrawal rate relative to your pot's real value is eroding faster than your cash balance suggests. The experience of higher inflation between 2022 and 2025 has already materially reduced the real purchasing power of fixed pension incomes, and while inflation has moderated, it has not fully reversed the cumulative damage of those years. The fifth reason is healthcare costs. The NAs provides free at the point-of-use healthcare, which is one of the most significant financial advantages that British retirees have compared to their counterparts in many other countries. But free at the point of use does not mean cost-free in terms of time and quality. NAs' waiting times for hip replacements, cataract surgery, knee replacements, and other procedures that become increasingly common in older age have extended significantly over the past decade. The average waiting time for elective treatment in England is currently over 18 weeks from referral. For conditions that significantly impair quality of life during the waiting period, many retirees are choosing to pay privately for treatment to avoid the delay. A private hip replacement costs between £10,000 and £15,000. A private knee replacement is similar. Private cataract surgery runs between £2,000 and £4,000 per eye. These are costs that previous generations did not face because NH waiting times were shorter and the expectation of private treatment was lower. For today's British baby boomer, the gap between what the N8s can deliver in a reasonable time frame and what they would like to receive is increasingly being filled by private expenditure. Over a 20-year retirement, the accumulation of these healthcare costs, combined with the rising cost of care in later life, should cognitive or physical decline require it, represents a financial exposure that most people in this generation have not quantified in their retirement planning. The sixth reason is lifestyle drift. Lifestyle creep does not stop at retirement. Rising every day costs quietly push spending higher than people ever projected. The baby boomer generation has, in aggregate, lived through a period of genuine affluence. They holiday more than their parents did. They eat out more. They spend on their grandchildren. They upgrade their cars. They make home improvements. And these are all legitimate and enjoyable uses of money in retirement. But the spending habits of the early retirement years, when health is good, energy is high, and the freedom from work is still new and exciting, are often significantly higher than the spending habits of later retirement, when health becomes more limiting and energy declines. This pattern, high spending in early retirement followed by lower spending in mid-retirement, followed potentially by high spending again in late retirement due to care costs, creates a spending profile that is much harder to plan for than a flat monthly drawdown. Many people in this generation are spending at a rate in their late 60s and early 70s that is not sustainable over a full 25-year retirement. And they will not discover this until the second decade of retirement, when their options for adjusting are much more limited. The seventh reason is the missing middle. Middle-income baby boomers are at the greatest risk, with most not projected to meet their spending goal under either measure. This is the group that is perhaps most at risk of a genuinely difficult outcome. The highest income boomers have significant assets, professional financial advice, and the margin to adapt. The lowest income boomers in many cases rely primarily on the state pension, pension credit, and public support, which, while modest, are guaranteed for life and do not deplete. But the middle-income group, those who earn too much to qualify for, means tested benefits, but too little to have accumulated genuinely substantial private wealth, face the hardest combination. They have a private pension pot that feels meaningful, but is not large enough to fund a full moderate retirement without risk of depletion. They do not have the financial sophistication or the advisor relationships to optimize their drawdown strategy. And they have a lifestyle built on a standard of living that their retirement income can support in the short term but may not sustain for 25 years. These are ordinary British people. They are teachers, nurses, engineers, skilled tradespeople, small business owners. They worked hard. They saved what they could, and the retirement they expected may turn out to be significantly shorter than their life. So what can be done? Because this video is not intended to leave anyone feeling helpless, and for most people in this situation there are still meaningful actions available. The first is to get a proper longevity-adjusted retirement income forecast, not a calculation of how long your current pot will last at your current spending rate. A calculation that models multiple scenarios, including living to 90, including inflation at various rates, including a range of investment return assumptions. Most people in drawdown are managing their retirement income based on a mental model of their pot that is far too simple. A proper forecast done by a qualified independent financial advisor, updated annually, is the most important financial document a baby boomer in or approaching drawdown can have. The second is to understand the role of the annuity in your specific situation. The annuity was declared dead by many commentators after the 2015 pension freedoms legislation. It is not dead. For someone with a modest defined contribution pot and no defined benefit pension, using a portion of the pot to buy a guaranteed income for life that cannot be outlived addresses exactly the longevity risk that most threatens this group. A partial annuity, covering your essential monthly costs, combined with keeping a smaller drawdown pot for discretionary spending and flexibility, is a strategy that many financial planners are now recommending for people in exactly the situation described in this video. The third is to take an honest look at the spending rate. The 4% withdrawal rule, which states that you can withdraw 4% of your pot per year with a high probability of it lasting 30 years, is a useful starting point. But it is not infallible, and it was derived from U.S. market data over a specific historical period. In the UK context, with current bond yields, current equity valuations, and current inflation expectations, some financial planners are suggesting that 3 to 3.5% is a more conservative and more reliable sustainable withdrawal rate. If you are currently drawing at 5 or 6% because that is what your income needs require, that is a number that needs attention. The fourth is to consider what assets outside the pension can be mobilized. Property is the most significant asset most baby boomers hold. For many, the family home represents a substantial and largely untapped financial resource. Downsizing from a 4-bedroom house that has not been fully used since the children left home to a 2-bedroom property releases equity that can supplement retirement income, reduce maintenance costs, and potentially improve quality of life by moving to a more manageable property. Equity release is another option that needs to be approached carefully and with independent advice, but which for some people in specific situations provides a legitimate way to access housing wealth without selling the property. And for those with buy-to-let properties, the decision about whether to continue holding them through retirement or sell them and invest the proceeds in a more liquid and less management-intensive form is worth reviewing carefully. The honest answer to why most baby boomers in the UK will run out of money before they die is not that they were reckless or irresponsible. It is that they are living longer than they planned for, in a higher inflation environment than they expected, with healthcare and care costs that their parents never faced, drawing from pots that are smaller than they need to be for the retirement that lies ahead of them. The tools to address this exist. The window to act is not closed for most people in this generation, but it is narrower than it was 5 years ago, and it closes a little more every year. The people who will navigate this best are the ones who face the numbers clearly, seek qualified advice, and make adjustments now while adjustments are still possible. If this video gave you something honest and useful to think about, Please hit the like button and subscribe to UK Finance with Peter for more straight-talking content on money and retirement for people living and working in the UK. Thanks for watching, and I will see you in the next one.